All right. Anybody have any specific things that you wanted to go over today, or do you guys want me to just jump right in? Oh, Chris, I've got his undivided attention, but your audio's not working. Oh, there you go. Kendra. Your screen was doing some weird thing. It was like blue and I don't know. I feel like you know something I don't know about a setting or something.
Listen, I had a laser procedure done on my face, so I'm just in hiding.
All right, Chris, you're unmuted. Were you going to talk or did you just forget to mute?
No, I had something funny to say about that, but I decided to keep it to myself.
Oh, that's probably good. Can't even crack a smile, huh? All right. Well, cool. Well, I'm gonna go ahead and jump in, and I guess if people jump on, awesome. And if not, there'll be a bunch of people watching the recording. All right. Let me get to the slides here. Anybody been seeing anything overly exciting or interesting in the market the last couple weeks, or been pretty consistent since mid-April? Sweet.
We have Troy. This is Kendra. Um, Jason had quite the fisticuffs this weekend with HOA and inspection little changes in the contract. So that's been fun. Uh, one of the listing agents we're working with doesn't think it's his responsibility to get us the minutes. And it's been a little gross, but it's been a fun learning experience for both of us on that new language in that clause.
So it sounds like it's still ongoing.
Yes. Yeah, it's not going to ruin anything, I don't think. It's just more of the agent sent us the list of numbers to call, and Jason was like, this isn't my responsibility. It's your sellers.
Yeah, I will tell you HOAs in general are we could have a whole conversation about that, but their like fees that they're charging now. I got a cash offer on one of my condos last week and they wanted to close quickly, which felt like it was a benefit to the seller until we talked to the title company and it's a lifestyle communities or whatever they call themselves these days. Um, and they have three, like they have a master association and then two like condo association people, and each one of them is managed by a different company. And so we had to pay rush fees for three payoffs, and it cost her like an extra $500
So
just
wait,
to get the payoffs in time to close early, which felt like it was a benefit, but I guess that's a an FYI moral of the story. Closing quick is not always better with a condo association.
so I'm glad we're talking about this. Jennifer asked Saf last week at a CE, maybe I'm trying to, I don't think anybody on this call was there, but she actually sent us language from something that said the fees cannot be more than the amount it costs to print or produce the paperwork. I'll circulate that to you and maybe you can weigh in on that. But it was something that's supposed to be protecting that price hike.
Like the rush fee?
The production fee itself. I'll put it in the chat when I
Well,
find it.
I mean, yeah, I mean, if that's a law, that's awesome, but every HOA in the world is violating it because it costs them nothing to print it.
Right.
It's a PDF.
I'm pretty
So,
sure this came from Tracy Chambers. So I'll try to find my email and I'll drop it in the chat.
Okay. Yeah, I would be intrigued by that. I don't want to spend too much more time on this, but yeah, I have a couple HOA condo association deals going right now that the amount of fees that the seller is paying to get payoffs is just ridiculous. And then the association won't give them copies of anything without the seller paying for it. Yeah, it's just a nightmare. All right, cool. Well, let's go ahead and get rolling. Hopefully, you guys, if you jumped in late or a couple minutes late, know you're not in an HOA, COA continuing ed class. This is the market update for May. Um, I think almost everybody on this call knows who I am, but if you don't, you can ask for the slides and I'll send you this stuff. All right, so main topics of conversation today. I won't say that I have anything crazy new in terms of like this great new nugget that I found. I would say that overall, it's the economic uncertainty stuff that we talked about last month around tariffs has continued to make the market jumpy, I would say. But overall, I think in Columbus, first of all, and maybe that's something I can do next month, is compare Columbus to other national cities and areas. But I definitely will tell you, as you guys know, I spend some time out in Colorado and be grateful for your market because houses are not selling. I know not every house is selling immediately or quickly, but there are many other parts in the country where prices are going down and houses are sitting on average for months, not days. And so just consider yourself lucky to be in Columbus. This is another squirrel, but I'll be quick with it. I was on every month or so, I do like a call with the person that runs my Google Analytics for my website or runs my pay-per-click campaign. And interestingly, the cost per click in Columbus is almost double this year what it was last year in the month of April, and actually going back to March as well. So we couldn't find anything in the data that really substantiated a reason behind that. It wasn't like a major change in conversion or anything like that. And so I'm thinking that it could be due to Columbus's market being better than national average, and maybe we've got Zillow or one of those other big players that's spending a lot of money on pay per click that wasn't last year. So, anyways, that was a little bit of a squirrel. I don't have a slide for that, but just something if you're somebody that pays for Google pay per click, I would recommend revisiting that if it feels like the number of leads for the dollar spend has been down. That is probably why. So I was shocked by double. Because we haven't seen our leads drop off, but the conversion's been a little bit higher on the clicks that we did get, so that's why it's kind of offset that a little bit. But to see the cost per click double was interesting. So all right, anyways, we're going to go through interest rates, which had a big jump today, unfortunately. Sorry to ruin your Monday if you hadn't noticed that. And that was largely due to the last of the big three credit rating companies downgrading US debt. Um, and then we'll also take a look at consumer sentiment, which, in my opinion, is the main driver for buyer activity. And then inventory and selling trends nationally, where are we headed there? And then also some local trends as well, and round it out with showing trends and rental trends again here in Columbus. So, did anybody else have anything as I click to the next slide that you wanted to go over other than that? Speak now or forever. No, you can interrupt me at any time. All right. So just a reminder, we're going to go over a lot of stuff here. And I know a lot of you guys are on here regularly. And so you're probably fairly numbers driven individuals who like this stuff and eat it up. And I'm probably just saying the same thing you've heard from a couple other sources. But if that's not you and you're on here like, hey, I just need to get like a drop of this something because I just really just don't think this way, I would just highly encourage you to focus. I'm going to go over a lot of stuff and just pick the one thing that you can know really well that you think could help you get more buyers and sellers to the closing table, right? Because at the end of the day, if you're not a numbers nerd and you're not here just because this is what you would be doing on your free time, figure out a way you can take this information. I really work hard to drop nuggets in around each of these topics to help you give you those nuggets. But if you ever like want to question me on how I've used it or anything else, please unmute, put it in the chat, or if you're uncomfortable doing that, you can also email me after the fact and we can have a conversation. But really the goal, if all you do is walk away with a bunch of knowledge, but you never actually implement it into your business, then I think you're missing the whole reason why we're doing this. So just make sure to pick something and roll with it. So like I said, unfortunately, rates bumped up, I think like 0.1% on average this morning. I wouldn't be surprised to see it bump up a little bit more. I don't know that we're going to go a lot more than that, but we are national average wise back over 7%. As you can see, for the most part throughout this whole year, since we saw this big drop in September, once everything got back up, we've kind of been in this, seven, definitely the 7.25 to 6.75. But really, I would say we spent most of our time in this range between 6.75 and 7 on a national average. That's typically translating into something in the mid to upper sixes for a local mortgage rate, depending on the lender, the day, and the program. FHA and VA tend to be a little bit lower. I don't have a local rate sheet this month because I didn't get one last week from the guy that usually sends it to me. But I think in general, unless somebody else is seeing something different, I think our typical 30-year conventional is like in that 6.5 to 6.75 range for the most part, with FHA kind of down here in that range. Anybody else seeing anything better on average? No, not really. I see Chris shaking his head. Kendra, all of your team, I appreciate you guys watching, but you're like the size of Lego people to me, so I can't really see facial expressions or head nods there. But all right, cool. So why did the rates jump? This is Mortgage News Daily headline on Friday afternoon. Basically, there are three large credit rating agencies, to not go too far in the weeds, but basically they rank different countries and cities, I believe, too, mostly for the bond market. And Chris, you can correct me if you know better on this stuff. This is not like I'm not an expert on the bond market by any means, um, but basically, they rate bonds in order to tell people without them doing all the research on their own of how quality that investment could be in a bond. And there's three of them. The first rating agency downgraded the U.S. all the way back in 2011. I think the second one downgraded the U.S. in like 2022. And then this was the last one that had us at what's called a AAA rating, which is the best that you can do. And on Friday, they also lowered our rating to the second highest that it can be. And they pointed to the fact that we have a lot of debt as a nation, and we don't seem to want to do anything about lowering it or getting rid of it. The biggest downside to this is that when your credit rating gets lowered, that means the interest rate we get charged is higher, and therefore it creates more debt because a lot of our, deficit spending now is just paying the interest on our debt. I think it's like, are we at 32 or 33 trillion now, or are we higher than that? I'm not sure. Anyway, somewhere in the 30 trillions in debt, and 1 to 2 trillion per year in debt. I think we're at 2 trillion that we're adding to the deficit or to the national debt every year as of right now. So basically, if you read the green highlighted part, it says basically that they kind of like to do that. Actually, no, it's still in the yellow. That when right now the Congress is looking at the budget for next year, and so I guess historically when the rating agencies do downgrade us, it typically happens during that time. It's their way of trying to influence and make them cut more than maybe they originally wanted to in terms of spending so they can lower the debt. So anyways, that's hopefully that was clear as mud. I felt like I kind of butchered that, so I apologize. If you guys have questions, I'll do my best to answer. Um, Consumer confidence. I think that outside of these, like, every day there's some new news piece like the debt downgrade or the rating agency downgrade and things like that. I think at the end of the day, that stuff usually comes out in the wash. But if I had to point to one piece of data that I think has the biggest impact on real estate in general, it is consumer confidence. The reality is the data to some extent actually doesn't really matter. It really matters how consumers are responding to it. So I found this as well as the next. Actually, I'm going to go to the next slide because I meant to put them in different order. So this is the overall like average index of consumer sentiment. So if you look up at this first line here, you can see this is basically, if you want to think of it another way, it's basically the consumer's confidence in their overall life, line one, and then line two is overall economic conditions. I would say though that at the end of the day, they're very closely tied. Money influences, as you guys know, a lot of the way we feel about how things are going. If you've never had the pleasure of being in a situation where you didn't have as much money as you wanted to have, maybe you won't understand, but anybody else that's like me that maybe has been in that situation before, it's hard to get excited about other things when money isn't right. And so consumer confidence is closely tied to the economic conditions. And basically, this is the April sentiment. Now, remember last month is when the tariffs got enacted, and I think we definitely saw the the real estate market take an familiar pause at the beginning of April last month. That wasn't normal. It wasn't in line with typical April tendencies, in my opinion. But then I think the second half of the month did start to come back to feel a little bit more like normal, and I think that's continued to for the most part into May. So I do think that this data is a little bit stale in this case, given that there was such a grenade to steal Mortgage News Daily's phrase thrown into the economy last month with the tariffs. And now that stuff has, for the most part, kind of leveled off with most of them either being paused. And it sounds like there's trade deals on the horizon. And I feel like overall, the average, it's not the headline of every newspaper every day like it was for 2 weeks at the beginning of April. Now, if we jump back, I mean, obviously, I doubt that anyone on this call or across the nation is going to be surprised by the fact that there's a huge difference in the way consumers feel depending on their political orientation. So if they're a Republican, it looks like they feel pretty good about the way things are going. If they're a Democrat, looks like they definitely want to jump off more bridges than the Republicans did when Biden was in office. And then the independents are kind of as normal, right there in the middle for the most part. It looks like current economic conditions, the independents and the Democrats are kind of more in line. But then index of consumer expectations, holy moly, that's even worse than the consumer sentiment. And so it's an interesting way to look at things, and I think obviously the truth is typically somewhere in the middle. It's just interesting that the like independent number almost always right in between the Democrat and Republican. So it's just, I thought it was an interesting way to look at it, and looking back historically to see how things change month by month is kind of a cool number. So. All right, jumping into national stats. So active listings, I'm not sure we should all be excited about this. I think there's some good, some bad, but we officially crossed over in April to be the highest number of active listings since before the pandemic. So this is the first month since 2020 that we've had this much inventory. And it looks like we're going to continue trending in that direction. I think the slope of the increase is probably going to gonna calm down and flatten out. We are definitely seeing that locally, which I'll get to in a little bit. But I would anticipate that we probably finish the year much closer to pre-pandemic levels than anything since then. In terms of the total listing count, so those were the actives. This is going to be the total number of listings. Um, and this is same story. So pretty much in line with the actives. Pending sales, those are down. This is a different way to look at things. So this is a year over year pending listing count. We saw kind of at the end of 2024, if we were to go all the way back, actually, that might be a fun little exercise to do really quick. But this area right here, what happened? Rates went back down to 6%, and look at what the pendings did year over year. And so I would, if we wanted no other, if we had no other piece of data other than this, I would say that, not say that anyone's surprised, but certainly the interest rates continue to carry the weight. And as rates have kind of bumped back up and stayed more into that 6.5% to 7% range, we see the pendings kind of staying about the same in terms of the decrease year over year. Now, the problem with that is that we have more new listings coming on the market, but we have fewer pendings happening. So that means we're going to continue to see inventory growth. What we would like to see is an increase in new listings and then also an increase in pendings and then subsequently sales. We really have not seen that happen. So if we continue on the same trend that we're on right now, it could mean trouble over time, but I think the inventory increases are starting to level off, in which case we probably won't see a lot of additional pain, but that we'll continue to keep an eye on. Days on market has come down, which again, as you can see from all the years past, is pretty normal. We typically bottom out either in April or May, and then starting in June, we start to bump up and we'll go up and up and up for the rest of the year. The exception to that is obviously the COVID year of 2020, but that was clearly an anomaly due to the pandemic. Median list price, again, kind of crazy that we haven't seen, and actually my verbiage over here is incorrect. It did go up 0.3%. You can't really see daylight there, but this is basically the third year in a row that we've been pretty flat nationally in terms of the median list price. So interesting information there. And then this is another thing that's been pretty out of whack for a while, is the percentage of properties that are seeing price reductions. It's still up, which is kind of bizarre considering it was up almost all of last year, but it seems like it's gonna continue to be higher than normal. I'm assuming this still has to do with just unrealistic sellers who are pricing high and then um, having to do reductions later. Median list price down everywhere except for the Northeast. So that's an interesting number, even though the year over year was up 0.3%. So that's kind of the math isn't mathing for me here, but this is what they're saying. So maybe just more listings, I guess more listings in the Northeast for some reason. I don't know. That's a weird stat there. All right, what's going on in Central Ohio? So year over year in April, the number of active listings was up 48.6%, which is pretty significant. Still only equals about 1,200 homes and condos, but still definitely something to keep an eye on. New listings was only up 10%, so that's definitely a fall off in buyer demand. And again, I am not sure, and Chris and I had a conversation about this like a month ago. There's nothing I've ever been able to find in trend graphics to see when exactly they pull this data. So I'm not sure if this is like a middle of the month thing, if it's an average thing for the month, or how they do it. I mean, I think as long as you're comparing trend graphics data to trend graphics data, it's pretty, the trends are what we're looking for. But I'm not sure, especially given how weird the month was last month, where I felt like the first half was a lot slower than the second half. I'm not sure if this is like the last day of the month or if it's an average number for the month. I'm not sure about that. So I would say for last month, we might want to take this with a little bit of a grain of salt. Um, all right, going local here for a second. Dublin schools. Again, new listings shot up, but pendings were almost sideways from March, up a little bit, but not quite as much as normal. So this gap between the new listings and the pendings was definitely larger than it's been since January, and maybe even more than January. So we have to go all the way back to last August before we saw a bigger gap. So if you're listing in Dublin schools, again, with April being a weird month, maybe we made up for that the last few days of the month, or maybe the first few days of May. But just keep an eye on that stuff when you see those kinds of breaks, because look how close those lines had been the last several months. And then we saw way more new listings with fewer pendings. So it's an interesting trend. In Hilliard, we saw a little bit more of growth in both, but still definitely a wider margin. If we look at last April, they were almost exactly the same. So again, something to keep an eye on. And then Olentangy, an even wider gap. So again, I would say just keep an eye out on this. As once we get May numbers again, I think that we'll have a much clearer picture. I have a feeling that the slow start to April probably impacted the total pendings. But just something to keep an eye on as you're going on listing appointments. And I guess the last thing that I would say, and I didn't go into great detail on either one of these because I did it last month, but remember that typically new listings and pendings, which I like to use as like an indication of buyer demand, tend to peak in May. So if that's Olentangy peaked in May, Hilliard peaked in June last year, and then Dublin also peaked in June. But just remember, if you're going on listing appointments, the second week, or well, the second to last weekend of June is typically kind of like the last hurrah before the July 4th kind of vacation season starts. And remember, the biggest reason for that is because if you go into contract at the beginning of July, close at the beginning of August, you're going to be hard pressed to give the seller some possession and still get moved in before school starts. So a lot of sellers tend to just go on vacation if they haven't sold already by July and then try again in September or October. You can see there was like a little bump in Olentangy in that October time frame last year. If we go back and look, it was September in Hilliard, and then in Dublin they just all threw up their arms and actually they had a bump in August, so they were like, screw school, my kids can deal with it. So all right, a couple interesting things. I think I might have already mentioned it here. No, I didn't mention this one. So this is month to date through the 15th. The number for sale is only up by 38% compared to the same time last year. Whereas remember, this is for resale only. The April over April was up 55% almost. So that's what I say when I say that we're seeing the inventory growth kind of start to plateau. Obviously, 39% is still a lot. But we're not seeing as much growth year over year as we were at the beginning of the year. And if you remember last year at this time, interest rates were going up in the spring. And so that was causing houses to kind of start sitting longer than before. New construction still continuing. As you guys know, those numbers are a little bit skewed just because not every new construction listing is put on the MLS. So I don't hold, and the numbers are fairly small as well. But all right, we already looked at those resale numbers. So local days on market, this is resale only. Average sales price compared to original list price. So this is pre any price reduction, is still at 98%. So same as last month, or same as March. And then days on market is dropping, although like we saw in the national data, it's pretty normal. We saw the same thing happen last year. However, we are up on average about 4 days on market this year in April compared to last. So something to keep in mind. Months of supply, though, this is interesting. We're obviously not as low as we were last year in the spring, but certainly like a pretty significant downtrend, which again is pretty typical with seasonality. But we're kind of back to mid-August levels of inventory. So not up and up and up like in terms of the months of inventory based on sales. However, as we've talked about many times, on the national scale, but this shows it locally. You have to go all the way back to Q4 of 2018 to really find levels, that we've been in over the last few months. So it's definitely a different market if you got your license post-pandemic. It's definitely a different market the last 3 or 4 months than you've seen in your career for sure. So be paying attention to that change. New construction, again, the numbers are, you don't hang your hat on these numbers in a big way, but just kind of same type of trend. Last year, starting in May, we saw inventory tick up. It looks like in April, maybe it started a little bit earlier this year. But builders tend to have houses be completed in the spring and summer when there's buyers in the market. And so we tend to see a little bit more builder inventory as we move into the summer. All right, so we did see, we did continue to see prices increase, which is again a little bit different from the national average. And this top headline here is not correct because the average active price was not down. Or was it? No, sorry, it was down year over year in April. I was looking at March to April, sorry. But then sold prices were also up 4.6%. So that is definitely still a good thing, still showing strength in our average sales price. I don't know about you guys, but the number of emails we get about somebody having a quote unquote big closing is way more frequent than in the past. So I definitely think the higher end of the market is moving pretty well, whereas parts of what I would call the messy middle of the market are probably not moving as well. So maybe next month I'll do something on that, actually. That might be an interesting thing to look at, the different price. I know Altos kind of breaks those out. Chris, have you studied any of that and seen like any data that supports that theory? It just feels like every time there's like a $2 million listing, it sells in a week. And some of the $600,000 listings will sit.
Yeah. Altos does support that. If you look at, they break out the top 25% and do it, the quarter of the market. But even talking to other agents, and as you said, we see these homes listed at 750 and they'll get multiple offers. And then we'll have something at 250 to 3 and not getting near as many showings as it was. I just think it's indicative of rates this long, economy, the uncertainty hurts maybe the paycheck to paycheck person a lot more than, someone that wants that house or relocating here. They can still tap into cash or worry about a refi later, and it doesn't hurt them as much. But I think, again, I don't think it's 07, 08, but the trend back then same thing. The rural areas and that lower pricing got hurt first before you start seeing it in the higher end of the UAs and the Dublins. So not to say that's coming, because I don't think we are, but we're definitely seeing, that trend, I guess.
Yeah, it's very, very interesting. And then, but the suburban school districts, like you put something on in that entry level price range and it flies. But I think the city of Columbus stuff, city of Columbus school areas have definitely gotten hurt, which, like you said, that's exactly how it happened in 2007 and 8. I agree with you that we're not going in that direction, but it's interesting how like slowdown in the economy hurts. It would be interesting to know, and I don't know, like obviously consumer sentiment, maybe that would be an interesting breakout of what it looks like at different socioeconomic levels, because obviously with the tariff conversation, there's a lot of talk of more inflation. And so if you're living paycheck to paycheck and you think that next month groceries are going to cost more, like that's a huge deal, way bigger of a deal, somebody living paycheck to paycheck than somebody who, is making $300,000 a year.
Well, we talked about this before, Troy, when this happened. When rates went up, they don't stay up for a long time. People can kick the can down the road for a little bit and then catch up. And when it goes this long, how long can you keep just putting stuff on credit cards and doing all that? All that goes up, and then at some point, you can't keep kicking the can down the road, so they have to pull back on like house purchases and things like that to make ends meet. I think that's
Yeah.
where we're at, and I think we'd see it at the high level. Again, not to get political, but if the tariff things, what it did to the market, and then the market came back pretty quickly, if it had really stayed way down for quite some time, I think people that had the discretionary income or income in the market might have started pulling back on buying too on the higher end stuff. So, that's why I don't think those got hurt as, long term, or aren't getting as hurt. But I think the longer rates stay up, it's just going to be more of the same on the low to middle price point.
Yeah, and unfortunately, obviously this downgrade that Moody's did last week is definitely not going to help us, in the near to middle term in terms of treasuries. They already weren't really pushing down, and now I feel like they have another excuse to not to kind of stay stronger than they have been in the past. So um, yeah, so the other thing is this was one of the things I was tracking in terms of the gap between the active list price and the sold price. It looks like it widened a little bit this month, so it'll be interesting to see. Obviously, it was at its widest in the April-May timeframe last year. So we'll see if that was just a blip in the radar. And once we get into, June, July, August, that active price starts to come back down again. Um, but that was something interesting. But I think overall, the biggest takeaway on this slide would be that, again, even though we have challenges for sure in our market, and it's definitely not 2021, seeing appreciation, average sales price up 4.6% year over year is something, it's rare air right now in terms of major cities in the US. So that's definitely a good thing. And also, again, to your point, Chris, and obviously everybody's personal budget is their personal budget. But I mean, that's a great stat to talk. This is a great slide, and I can show you how to get to it and get a cleaner version if you want to put it in a listing presentation or something. But the fact that we're still continuing to see year over year price appreciation is a good way to motivate buyers to move instead of sitting on the fence if they have the financial means to do it. Because I know, especially when the market tanked, there were a lot of younger buyers that we had that kind of hit pause for a second because they're nervous and they've never been through. They know about 2008, but they didn't go through it. And so they had just never been through like a true correction like that, outside of COVID, which is obviously a really unique and easy to say, like, that's what's happening type of thing. And so, yeah, it's just interesting. So leverage data for those emotional conversations for sure. All right, this graph has continued to be fine, but not really play out the way that I thought it would in terms of interest rates versus showings. I have put a couple years on here, last year and this year, just to kind of see, and still no real correlation. I think Chris's point is a really good one, that I think like the degradation of showings has been more about just this long-term pain that people are starting to feel with rates staying high. And I think there's just, going to continue to be this until we see some relief in interest rates. Um, all right, then this is our total showings. So this, I think I'm gonna have to remove some of these colors because it's getting pretty crazy. But right here, the light blue is this year. So you can see we're right even last week with 2023 in terms of showings, maybe a bump higher. So the second highest number of showings last week um, of the last 4 years. So that's good. We're still seeing overall good activity. But the one thing that we've started tracking was the showings per listing. And this is where I think some of us are feeling it in the market, is that this is last year compared to this year. So obviously the number of showings per listing probably a lot lower than what we thought it was in terms of an average, but I like to look at the percentage change here as more of an indication. And I think, I don't know about you guys, but we've definitely felt it in our listings, just the overall number of showings. It looks like, just spitballing it, are probably down about 25 to 35% depending on the week. Um, and so I think that's definitely what we're feeling, and definitely something that you want to be sharing with your sellers. Not necessarily this, I don't know that you want to go this deep into the weeds with most of your sellers, but I think just saying that the average property is getting 25 or 30% fewer showings than they were last year is definitely something that is going to help you when they don't get the 20 showings that their neighbor got 2 years ago that was a silent expectation of theirs. So again, just making sure that we're setting proper expectations. And then last but not least, literally nothing exciting happening in the Columbus rental market. I mean, this is about the most boring graph that you've ever seen in your entire life. It's basically been the same price ever since the beginning of the year. And I'm seeing the same thing with our rentals, that for the most part, you're just not seeing any kind of massive appreciation in rental prices, but you're also not seeing, depreciation either. And most rentals that are coming on the market weren't just listed last year. So most rentals that come on do have an opportunity to increase rent. And I do think, again, this is an average. I do think in definitely the suburban markets, where because of higher interest rates, the cost of buying a home has gone up, but people still want to keep their kids in the same school district. There's definitely more of an opportunity in those markets. Your Dublin schools, your Worthington schools, Hilliard schools, in that sweet spot, like of 3 bedroom, 2 bath, $450,000 home to see some rent increases there, just due to how much it would cost to buy that house, and a monthly payment is typically still more than what you're paying in rent, which is wild. We've been saying it for a couple years now, but those are the first couple years in my whole 21-year career that I've had to say that, because it's almost always been cheaper to buy than rent. So not the case at the moment. Taking out appreciation, of course. All right, those are my sources. Anybody have questions? Real quick, because I think I forgot to say it last month. If you guys want these slides, please email me at troy@marshhomegroup.com, and Allison will send those over to you. And then also this video gets posted on the One Team YouTube page, usually within a couple days. So that being said, though, anybody have any questions, thoughts? Chris, did I miss anything else that you wanted to share?
No, I mean, I think you hit I think everyone's seeing it. I know we have a fair amount of listings too, and it's just, I think me and you talked last time, we just said it's like almost, it's confusing to try to describe the market, because we'll have one listing go like that. We'll get another listing that seems like it should go like that, and it doesn't. So I think you touched on it. Some of the suburban areas, other areas other than Dublin maybe take a little longer. But we had a brand new flip in Hilliard that was in great shape. Barely had any showings. We got one offer, and that's all it takes, but just not the same market. So I'm starting to see more balance, I guess, across the board.
Yeah, for sure. I think that that's like the perfect example, and yet stuff is still, it is still moving. You know, like you said, you're not getting 4 offers in most cases anymore, except for there are a few pockets that are still like that. But even stuff that has really low showing activity, it feels like a lot of the time, if it's priced correctly, you're still getting an offer within that first week, and it's usually a decent one, or you have the ability to get it to a decent level. Where are you seeing and anybody else, please feel free to jump on, but where are you guys, are any specific areas or price ranges that you're seeing stuff sitting like months and months, or is it still very sporadic, like where one house sells in a week and then another one just sits for a couple months for some reason?
I mean, to me, I think just because we have stuff low priced and then all the way up to higher price, the really low will sell quick and the really high will sell quick. And it's that middle range. And I think it's what we talked about, where a lot of people maybe aren't looking to move up right now because they have that small low rate. So they stay where they are. So those middle range prices that maybe a new buyer can't buy into, but no one's really moving up to because they're staying put while the rates are down, their existing rate is lower. So that inventory doesn't seem to fly as much. I'm hoping, if we do get a drop in rates, it can spur some new home buyers to be able to move on that 400 to 500 range, 350
Yeah,
to 500.
it seemed like that was coming here for a minute, but then yeah, just it seems like every time we get a couple weeks of good news, then something bad happens, and it gives them an excuse for the 10-year to go back up again.
Yeah.
So, for those of you that didn't see it, Kendra put, I guess it's Ohio Revised Code, that homeowners association residents have a right to examine and copy the association books and can only be charged for reasonable costs for making copies of this document. That's a really interesting point. And who also has a law degree that wants to file a class action lawsuit? Because this sounds like, I mean, the commission thing is one thing. This sounds like a slam dunk.
Isn't it though, Troy? So again, I'm pretty sure the root of finding that was Tracy Chambers. So if you do have questions, maybe route them to her, because like I said, Jennifer sent that as a follow-up to a CE we did last week.
Yeah.
Yeah,
I
I
mean,
think this would be perfect for Marie Donofrio. She is very up on the whole condo association HOA stuff.
yeah, I just want to know though, if it's part of Ohio Revised Code, how they're still getting away with it. Like no one sued them. Anyways, I guess it's going to be on YouTube.
Does your client want to sue?
No, I want nothing to do with it personally, but I hope somebody else will pick up the flag and run with it. So, but yeah, I think everybody in the chat is kind of agreeing. So, all right, cool. Well, if nobody else has anything, I appreciate you guys jumping on. And hopefully you guys have a great rest of your month. And I am going to do a little bit more research, probably look at Altos a little bit, and then also look at our local market stuff and see if we can come up with any trends that kind of show those different price range breaks for next month. So like I said, email me if you want the slides. Never hesitate to reach out. You guys have an awesome day.
Thanks, Troy.
See ya.
See ya.
Thanks, Troy.
Yeah, see you guys.